So just give everyone a backstory. We're going to be diving into the capital gains changes and what they mean. So we're going to look at the changes, how they will impact different Canadians in different ways. We're going to look at the different solutions available to you to try to minimize or avoid them, break down how this is going to change real estate investing, owning a business, and different investing in Canada moving forward. And then just talk a little bit about kind of what we can all do about it, what opportunities are available to minimize this, and other opportunities to just pay less tax at the end of the day. Yay.
There we go.
My favorite nerd. Awesome. So I guess we'll dive into it. I think we're going to keep having people trickle in, but I'm going to be posting a recording for everybody as well. So I started the recording. Sadly, the webinar app doesn't allow me to set up a transcription, but that'll be what it is. I will warn everybody, and Chris, I'll warn you as well. My internet service provider is doing work today, so I've lost internet 3 times today. So there's a chance that if I just disappear, well, you're the accountant, you don't really need me. But just in case I do disappear, that is almost certainly what it is. So Chris, I guess we'll start. You're the accountant, but we'll make this clear. This is not tax advice, everybody. This is an understanding of the changes, but please consult your actual professionals. Chris is a chartered professional accountant and very close to being a certified financial planner, which I find interesting. He's got a very broad set of knowledge. And I'm a mortgage broker. We're both legally fiduciaries for our clients, but I do want to be clear, you are not our clients from this webinar. If you're interested in working with us, please reach out. But at the end of the day, we want to educate and inform you. We do not want to get sued. So please just keep in mind that you should consult your independent professionals, but our goal is not going to be to sell anything here. It is just simply to make this make sense, because there's a lot of confusion. And I'll even fess up. I sent Chris some screenshots of a comment that I quickly took down because I thought better when I was frustrated with someone else. And I actually had it wrong initially. So it is convoluted, and the way they worded things is pretty vague. So Chris, do you have anything to add before we jump in?
Oh, and the other thing is, this is not law yet. So this is just a budget announcement. We don't have the details. And with most things, the devil is in the details. And so when this actually becomes law, which sadly might be past June 24th, then we'll actually know the full details. So at this point, there are assumptions that are being made and broad languages that will end up being clarified in the eventuality of time.
Perfect. So always gets a little legal for this stuff, but it's kind of a balance, right? There's an election coming up, and a lot of these changes are political, and my promise is I'm going to stay neutral on that for this. But at the end of the day, things could change. So please keep in the loop. We've seen, and maybe we'll use this to kind of dive into it, Chris, is the current climate, the UHT filings, the trust disclosures. Has there been a common theme of a change is announced, even partially implemented, and then things change after the fact? Like, what have you been seeing kind of with legislation in general?
I mean, I think over the last number of years, it's been predominantly real estate driven. But I mean, we had the introduction of speculation and vacancy tax. We had the UHT, the trusts, as you noted. We have the federal flipping tax rules in effect. Next year, as of January 1st, 2025, we're going to have the BC flipping surtax. We have a tightening of the alternate minimum tax that is already in effect, which can play a trap within these rule changes. We obviously have these capital gains changes that we're going to be discussing. And then we also have back-end changes. For instance, Airbnb, VRBO, and a number of online reporting sites now have to report their information to CRA directly from the back end. And in BC, we had a brand new renters housing credit, or a credit that was on the tax return. And in order to claim it, the taxpayer had to disclose the address they were renting, the total amount of rent that they were paying, and the name of their landlord. So you've got to know that somewhere there's a database being created that's going to compile all of that information from the renter's side and then compare back to people's tax returns. So in general, we're seeing a tightening of a lot of rules, but then we're also seeing a lot more information going directly to CRA. And so, the idea of the Wild West of kind of, how are they going to know whether I'm renting or not, or sort of, games that people have sometimes played, those are coming to an end, and the penalties that we're seeing are starting to get to be quite large. And so it's just generally, you're buried, one, in compliance, and two, there's just going to be a lot of other reporting that's required.
So are you seeing a trend, like my understanding, and I prefer to get this from you, is the CRA finally getting with modern times and digitizing?
Yeah, I mean they're hooking their systems into more and more things. I mean they apparently have a link to the back end of permits and titles, so they can tell when there's a construction permit pulled, and they can tell when there's title changes. So you have to think, with AI and the more powerful those kind of bots, or however things are happening on the back end, that there's a lot of comparisons and/or things being matched up, that's happening, and certainly that's a function of the digital age.
Yeah, it's an interesting one. So let's get to it. What everyone's here for, like, what exactly did they change with the budget when it comes to capital gains?
Yeah, so the change, there was kind of twofold change. The main one that we're going to be discussing today is the change in inclusion rate. It used to be taxable at a capital gain was taxable at 50,000 or 50%, and the inclusion rate has now gone up to 2/3, so functionally 66.666%. So on the surface, that seems, a 66% or a 16% increase in the inclusion rate is not really that big of an issue. The reason is that how it flows through for everybody is where the impacts are going to be. Generally speaking, as well, for at the individual basis, this isn't going to come into play at unless your gain is more than 250,000. But the bigger circumstances, the bigger issues are going to be that this happens from $1 for corporations and trusts. That's where we're going to see a lot of the impact. Now, the secondary change was that there is changes to the lifetime capital gains exemption. They're increasing that rate up to 1.25 million. But the reality is,
Exemption, is that for business owners?
it can be, and that's where a lot of misinformation is coming about, is that that only applies to qualified farm and fishing properties, as well as eligible qualified small business corporations. Corporations that are, holding companies, passive in nature, aren't going to apply. Plus, you need to have actually sold the shares of the company. And the reality is, a lot of transactions, business to business transactions, are asset sales, not share sales. And they would not have the ability to claim this gains exemption because that only occurs on the sale of the actual shares. And so, despite them heightening that gains exemption, it's not going to be applicable to the vast majority of people. But that's where the misinformation starts to come in. People start to think, well, oh, the gains exemption has been increased, so therefore there's not going to be an impact to companies. And that's just not the case.
No, absolutely. Now, maybe let's just make sure everyone's on the same page. Can you let everyone know what a capital gain actually is and how it's taxed? Because I've seen so many people just outrageously wrong on it.
Yeah, so a capital gain is the difference between the selling price of an asset and its adjusted cost base, less any selling costs. And so generally speaking, let's say we purchase a property for 400,000, we sell the property for 500,000, net of any costs that we incur, there would be a $100,000 gain. And then under the old rules, the inclusion would be that 50,000 would get added to your income. And under the new rules, 66,666 would get added to your income. So it's, what you're not taxed on the full 500,000, you're taxed on just the profit from the time of purchase. Now we call it the adjusted cost base because there's things that go into adjusting, what that cost actually is. So for instance, you buy a property and you put a bunch of renovations into it. Those renovations, generally speaking, are not deductible in the year that they're incurred. They get added to that cost base. So again, we change the example slightly. You purchase the property for 300,000, you put 100,000 of renos into it. Now your adjusted cost base is 400,000. So it's the spread between your purchase price and the eventual selling price that is creating the gain. It's not coming off the full 500,000 that's coming in. It's just on those profits.
So one of the confusions I've seen people had is let's say the current rule is 50% of the capital gain. Is it the 50% that is taxed, the 50% that is added to your income to decide your marginal tax rate, or both?
Yeah, I mean, there's a lot of confusion, and they're saying, oh, it's now 66%, you're paying tax on 66%. No, it's the income is being added. So the 66, in this 100,000 concept of gains, you have a $66,000 income inclusion, but then that gets taxed at whatever rate is applicable. So if we're talking about personal tax rates, more than likely we're talking about the highest bracket, because obviously it's not kicking in unless it's 250,000. So you're potentially paying 53.5% on the 66,000. So now we're incurring, the 40,000 of tax on that. Whereas in the corporation, you're going to have to pay your, all of the various tiers of corporate tax, which includes the refundable taxes that get charged and the general rate tax, and all of those things would generally work out to just over 50% prior to the refundable taxes kicking in.
Just to warn everyone, we are going to send out some examples after. They'll probably go out Friday, Saturday, Monday. I don't know, but they will go out. And Chris shared a tweet with me as an example from someone that was showing the actual impact for corporate taxation. It must have been 7 tweets long, eh, Chris? It's
Yeah,
not
at least.
short or simple.
And that's where a lot of this confusion is coming in, because you're seeing a change from 50 to 66%, and then you're seeing, well, how does that actually work? And the functional impact, and even the title of this video, right? 32% tax increase. Well, where do you get 32% coming from, right? All of these, there's so many different numbers that are kind of floating around, and that's where a lot of the confusion is coming into play. And so, let's talk about the impact on a corporation, because they're the ones that are going to be the most impacted by these rules, right? So it's going to be people who either have saved or have rental properties and or other assets in their company, and or have been saving in a holding company as if it was a functional pension plan, and they're going to have to realize gains in order to take that money out during their retirement. So what is the impact there? Well, before, when you had that 50% that was being taxed, you also had 50% that was a capital dividend, and that was able to come out of the corporation tax-free. And so this followed the concept of tax integration, because this follows along the same rules that apply at the personal level. That if you, at the personal level, you only had to pay 50% tax, well, then the corporation would have the similar treatment. Now, under the 66% inclusion, you're going to have a smaller capital dividend that's going to be allowed to be paid out. So that means that the amount that comes out of the company tax-free is going to be smaller, which then increases the amount of dividends, taxable dividends, that you need to declare to get that same gain out. So the reality is, you, on a flow-through rate of calculating all of the numbers combined, which are quite convoluted in themselves, you were paying close to a 30% rate when you realize the capital gain on the company's side, 29 and a half sort of approximation. But now the actual tax rate that you'll be facing is closer to 39, 40%. Now, obviously, your personal tax brackets are going to affect these things when it comes to the taxation of those dividends. But what we can see is that there's a 10% real tax rate increase. So if we're taking, starting at 30% and going to 40%, 10% increase, that's a 33% tax increase. And that's where that number is coming from. And so again, like I said, there's so many different numbers that are kind of going around here that it's hard to sort of follow, how does the portion of income that gets added in really impact my life?
Well, maybe
And
let's
so
just break this down into bite-sized pieces, because I see some of the questions, and let's just clarify. So I think let's start personal, if you're okay with that, because I think that's the simplest change to break down. So previously it was you paid a 50% capital gain on the profit of selling an asset, to simplify. What is changing? Because I think there's confusion about the 250 limit. Is it 66% on the full gain if you go over 250? And does it reset annually? So what is the change that's happening on the personal level?
yeah, so it's going to be calculated annually because it's on your tax return. And similarly, it's going to be the extra inclusion will be incremental, just like your tax brackets. And again, a lot of this confusion boils down even to people's misunderstanding of the basics of tax, right? If you are making 75,000 and then you get a $2,000 raise and that happens to cross a bracket change, it's only the $2,000 that are in the other bracket that gets taxed at that rate. It's not that all of the historical earnings get taxed at that rate. So similarly, at the personal rate, for these capital gains, the first 250,000, that's going to remain at a 50% income inclusion, and then the excess amount would have a 50 or 66.66% inclusion. So let's say if a potential $300,000 gain, the first 250,000 is going to be included in your income at the old rate, 50%. And then the 50,000 that's in excess of 250 is going to get included at 66.6%. So in that, if you did the math on that sort of example, we're talking about, you're paying tax on an extra 10,000 of income. In the scope of a $300,000 gain, that's not a dramatic change. Where it will,
for all the investors that are thinking they're going to strategically sell properties right before they hit that 250K in gains, it's pointless. Sell when you need to sell on the personal level.
well, and I mean, we're already seeing articles about how there's apparently a rush to sell Muskoka, properties out in Ontario, and the government is actually kind of counting on this. They're within their own budget projection. They're forecasting a big boom in capital gains collections for this 2024 year. And then a drop off in the following years because they believe that this rule change is going to panic some people into selling before this June 24th deadline. And the reality is, again, what are you going to do with that money after it's sold? Because if you go and buy a new asset that's going to be subject to capital gains, well, then you're going to be subject to those rules eventually anyway. And secondarily, now you've chosen to incur a tax cost. So you now have less money invested. And so you're going to have a lower overall rate of return in the long run. And also, and we're not going to be able to get into the components of this, but they already have the alternate minimum tax changed. And on very large capital gains, you're actually going to potentially incur a secondary tax calculation called the alternate minimum tax, which they'll argue is a refundable tax, but for many people, they're never able to recoup that. And so if people rush out to sell properties right now, they are, without doing the math and without getting, some proper planning, they're potentially going to incur some alternate minimum tax that they wouldn't have had to. And then also they might have an impairment of their overall capital for the next 20 or 30 years by paying some tax early instead of paying the tax down the road.
Now, this 250K, we'll call it limit, that's a per year basis, right? If you realize 250,000 in gains for 10 years in a row, the rule and changes won't impact you if you never cross that 250 mark.
That's right. And it's also tax returns are on an individual basis. So if you share a property with your spouse, then now all of a sudden you would have to have a $500,000 gain because it's 50-50 profit. And each one of you is going to have your $250,000, inclusion at the old rates. And so you would have to have, a pretty significant rate. In the reality is that's a way to work around this. You could add more owners, right? There's going to be downsides to all of these different strategies. But for instance, you have an adult child that you trust. Well, now a third owner on title. Well, now all of a sudden it's $750,000 of gains before those other rate changes incur. And so, it is calculated individually.
Now, I know there's a few brokers in the room, and I'm a mortgage broker, so I will add, adding multiple people on title has its own financing problems. And the reality is that whenever something like this comes out that's a negative, sadly, the solutions that come forward, maybe instead of having a 10% increase on taxation, there'll be a solution that is a net 3% increase. Even the solutions or compromises are still going to suck more than it was before, but they might just suck less than the alternative of doing nothing. Now, Chris, would you agree with me or disagree that the least hard hit people are employees, particularly pensions and things like that, that own properties personally? The next hardest hit are people that own real estate and other assets corporately. And the hardest hit individuals are like doctors, mortgage brokers, realtors, people that build assets inside a corporate structure, but never really have a business to sell.
Yeah, I 100% agree with that. Doctors specifically were allowed to incorporate instead of getting a raise. And so the government gave them this incentive of being able to save at the corporate level. And now you would have a big set of doctors that are going to be close to retirement who have been operating under one set of tax rules, done all their planning, and then, the year of their retirement, they now have a 10% actual, tax hit. The reality is, and here's some of the way that these numbers sort of work out. Under tax planning, if you want to retire with $120,000 of income, under the 4% rule, you would want approximately $3 million worth of assets. So there's plenty of professionals and doctors and lawyers, accountants who save within holdcos trying to build up to a number like 3 million. So how would that typically look? Well, they probably put 1 million to $1.5 million of cost base into that holdco, and then the assets have grown to about 3 million by the time that they go to retire. So that means that they have capital gains or future gains on $1 million to $1.5 million. Well, going back to the original conversation, this is a real impact of 10%. So that means that the cost, the cash that they will have at their personal level to retire would be $100,000 to $150,000 less than what they were planning prior to last Tuesday. And so you can understandably think of why people would be upset when this is a retroactive change and they've been playing, according to the rules as they understood them, and they have little to no time to react or pivot or change their strategy.
Now, Chris, do you see the poll option? I set you as host. If you can trigger if you get the option to trigger the first poll, please do, because we're going to roll into this in a minute. It'd be nice to know everyone that. I did see a question from Jim about, does it make sense for doctors to crystallize these gains prior to the changes? I'll go out on a limb and say probably not, because you're going to pay taxes, create a smaller asset base, therefore have less appreciation or increase of your assets long term. So you're probably better off to just eat it, because ripping off, a massive band-aid for these professionals with corporate assets, you're paying close to 50% tax at the corporate level, and then there's all sorts of tricks and things. But at the end of the day, shrinking the pie is probably going to hurt you a lot longer than just eating these higher taxes gradually over a period of time.
With the polls that you have here, is that the rental poll question
Yes,
one
the
or
rental
income
poll.
poll?
We're going to tie into the rental one.
Rental poll? All right, I can launch that. There we go.
All right, everybody, I set so we're going to dive into structuring rental assets. So I'm just curious if everybody wants to answer this quick. Do you own rentals? Do you not own any rentals? Do you own rentals personally or corporately? And if you own personally and corporately, just answer the corporate side. Just want a gauge of where to put our attention and time for this stuff. So maybe Chris will give it about 30 seconds, and then if you can close the poll.
Yeah, I'll
No.
end it in 4 or 5 seconds.
Perfect. Now, someone asked, do these changes impact your primary residence? And I'm going to be the political one here and say, no, they don't as of today. I know there's a lot of studies and a lot of scary stuff about what the next 10 years might be.
Yeah, exactly. I mean, currently, because there's not a taxable gain being incurred, then this is not going to impact your primary residence. This is impacting taxable gains. So we see, I'm not sure if it's displaying on the end, but we see 56% of people say that they own rentals in their own personal name. 27% of people own rentals in a corporation, and 18% don't own rentals. And so the reality is, if you already have a rental in a corporation, you're kind of stuck. You have either the choice to sell it out of the corporation and realize that gain and get it to the personal level. And again, like we noted, have an actual tax cost of that crystallization and the smaller pie to work with. And if you have the rentals under your personal name, then the critical thing is going to be planning around it. You may or may not ever be impacted by these changes.
And I'll give an example of that because the investing side's a lot of what I do. If you're investing in Toronto or Vancouver, exceeding a $250,000 gain where you're having a relatively few large assets with the expectation of large appreciation, those markets will be hit a lot harder than, let's say, you invest in Regina or Saskatoon, where you're buying more smaller assets and you're getting a larger portion of your returns from, let's say, cash flow, from generating income on an annual basis. Those assets may appreciate less. So it's going to be very interesting for the investing community, which a lot of you guys are, how these changes shift the different strategies. There are other real estate investing strategies that go more towards earned income, where you can actually realize like agreement for sales, wholesaling, rent to own. So it's going to be very interesting. There's going to be a lot of layers of changes as the professionals digest this. Well, first they have to ratify it into law. And someone had a question about that, Chris, do you know when the dates are for this stuff to be ratified into actual law?
They would actually have to sit in session and pass laws. So who knows in that regard? They don't have a fixed schedule in that regard. The secondary thing is it's going to be a matter of planning and especially really driving down to what your personal goals are. Because for instance, if you're holding 5 properties until you pass away and there's a deemed disposition on all 5 properties, and then more than likely you're going to have a significant gain and you might be impacted by that, right? So if you're trying to build wealth for the family, but you're doing it by holding on to the properties until the very end, well, then you could have a negative consequence to this. But if you were selling off, strategically selling off the properties and or transferring them into kids' names earlier, 1 per year over the course of 5 years, and intentionally distributing some of your assets, well, then you might not ever incur those rate increases. Similarly, in that same vein, while you have your spouse around and you have that dual ownership and 500,000 of gain to work with, you're going to have a lot more options than if one of you passes away, the second person absorbs all of the value at the original cost base, and now all of a sudden one person is disposing of the assets. And they could have accumulated for a long period of time. Well, now there's going to be, in those situations, a lot more people affected. And so the reality is, if you just let life take you along, then you might be affected more than if you have a plan and you're intentional about, when assets are moving, how you're realizing gains, what the taxation is, and being intentional about this, then you might not ever have that impact.
So would you agree that for at least real estate investing, which many people here are involved in, personal ownership is impacted zero for some, a little for others? There could be if someone's sitting on a few big assets substantially, but there's layers to it. Whereas for owning real estate corporately, it's a substantial change.
That's right. From corporate ownership, from $1, you are going to be impacted. And so similarly, specified investment business income has always been slightly punitive. So to have passive income at the holdco level has always been slightly punitive on a flow-through basis. In BC, it's about at the highest rate, it's about a 5%, distortion in income. But what happens with this rule change is that the integration is completely thrown off. Right now, you are facing a massive consequence, potentially up to 15%, by your choice to own within a corporation. So that's going to lead to differences in how you do things, whether you choose to buy in corporations or whether you choose to buy personally. Generally speaking, there's going to be a lot less impact on the personal level. And so, ideally, we're going to see a lot, well, not ideally, as a result of these rules, you're going to see a lot more strategies pushing assets down to the personal level, rather than retaining them at the corporate level, due to this tax leakage or this lack of integration. And this is one of the things that is most upsetting within the accounting community about this rule change, is that the basis of the tax laws have always been that there's an integration between corporate and personal, and this rule change flies in that face.
You say
And
integration, you mean the balancing?
well, generally speaking, it's the tax code is designed that if you set up a corporation and you earn $100, you earn $100 just individually, you're going to pay X dollars amount of tax. And then you set up a corporation and it pays tax, and then you issue dividends. If you add those two numbers up, they're supposed to be very, very close to identical. That's called integration. This might be two different numbers, a portion that's corporate and a portion that's personal, but between the two of them, they're supposed to be the same. Similarly, obviously, a wage that's coming into the corporation, well, that's taking away the corporate income, and so wage to wage is going to be equivalent. But on a flow-through basis, it's supposed to equal the same amount of tax, whether it was earned personally or earned corporately, due to the fact that the corporations don't have this $250,000 exemption under the 50% rules. That integration is broken, and so it is going to be problematic. So similarly, and we don't know the rules here, there are things like, for instance, a disability trust, right? One of them, if you have a child or someone with a disability tax credit, one of the big appeals is forming a qualified disability trust, because you can get some credits from the government to build up some assets. And generally speaking, those trusts realize the income and then distribute to the beneficiary, and it doesn't impact their benefits, because a lot of disability benefits rely on what the personal income is. Well, currently, trusts also face this higher inclusion rate right from $1. So generally, when the government says that only 0.13% of people are impacted, and it's only the richest people in Canada, I, generally speaking, don't know that many people with disability trusts that are among the richest people in Canada, and they certainly would be taxed or would be incurring negative impacts due to this rule.
Well, I think the problem is that maybe hypothetically 0.13 is arguably true. What they leave out is that That's per year. And there's a very good chance if you're, let's call it a middle class Canadian, at some point you pull your ticket, whether it's when you pass and you leave your estate to your kids, if you own a couple of properties or a business, even a second home. As I learned from you the other day, if your primary residence is an acreage, damn it. So it seems like it is going to impact a lot of people in a very broad sense. It may not impact you on an annual basis if you're just a regular middle class person, but probably at some point in your life, this is going to bite you. Now, someone asked Chris, this change is essentially retroactive in the sense that once we cross the threshold of it triggering, once they implement this, if you realize a gain, the new rules apply. It is not based on gains realized before the changes, correct?
That's correct. Yep, it is retroactive. If you have those assets that have gains, you either have the choice to trigger them before June 24th, and if that date passes, there is again, without seeing the actual laws, there doesn't seem to be a mechanism that you would get out of paying this extra inclusion.
And what is June 25th? Are they basically saying they're going to ratify this before June 25th?
It's just the arbitrary date that they have deemed where the rules will come into play.
So it's a big maybe is what it comes down to.
Yeah, I mean, they could always change it.
Interesting. Now, do you want to trigger the second question, the income one, just so we have an understanding of everybody where to kind of shift this conversation? But just to recap, it sounds like the structure of real estate investing is going to shift a little bit for, once again, not the titans that buy 1,000 properties, they'll still incorporate, but for the middle class folks who buy 4, 5, 7 properties, it sounds like it's going to shift where maybe if previously 3 out of 10 scenarios it made sense to incorporate, maybe moving forward it'll be 2 out of 10. So it's not going to eliminate it, but we're just going to shift. There's more barriers or more friction for people owning real estate corporately. Would you agree that's correct, or would you change that?
No, I think, there's a lot more. The original source of income is going to depend a lot more. So generally speaking, I would say if your source of revenue is coming from a corporation and you're paying corporate tax, and then you have the ability to invest corporately, well, then there's going to be strategies that will still make sense. But if you are a wage employee and then you're just intentionally choosing to hold assets at the corporate level, but your source of funds is at the personal level, I don't think that that's necessarily going to make as much sense going forward, to intentionally put yourself in that situation.
Now, and maybe you won't answer this fully right now. Trying to think of the best way to word this. If someone, let's say someone is a CEO, some sort of position where they earn a very large wage, a high wage, maybe a salaried dentist or whatever it may be, would it still potentially make sense to move assets into a corporate structure to use things like participating whole life to create that estate benefit? Or is this stuff that's going to take professionals months and months and months to chew through to really get an answer?
Yeah, I think it's going to be highly individual, and it's going to be a matter of every context mattering. Certainly, things like whole life are going to be more appealing at a holdco level or at the corporate level. But generally speaking, though, those, they still make more sense when, again, the funds are coming from another corporation. So the idea of, paying the personal level of tax and then pushing it up to the company, well, you could always have just a policy at the personal level anyway. So why do the extra layer of the company? I don't necessarily know that there would be benefit, but there might be for some people. It's going to be highly individual, and that's going to be why you're going to need to run the numbers. That is like the end result of all of this is that there's not going to be easy broad-based answers that apply to everyone. You're going to have to run the numbers for your individual situation.
So now I think we're going to get into the fun stuff. And that is, what can people do about it? Now, not so fun answer. There's not a lot of options, but vendor takebacks, as an example, I do not believe this will make an impact corporately, since they sadly made it applies on everything. But at the personal level, let's say that I own a property in Vancouver, and in 30 years I want to sell it and I've paid it off. If I use a vendor takeback and sell it and defer the capital gains over 5 years, theoretically, if I could stay under, would that help minimize the amount of money using that 250 exemption each year, theoretically?
Yeah, that's right. I mean, a vendor take back loan spreads the gain over the course of the loan. But again, you'd need to also do the math of, if you only have some of your money in your hand in year 5 versus having all of your money in your hand in year 1, that's lost opportunity cost of being able to invest it. So you might, if you sold it and had all of the money in your hand in 1 year, well, you got to invest that money after paying potentially higher rate tax, or do the math. And if you spread it over 5 years and got to invest smaller portions, where do you end up as a result? But that's going to be a math question and a planning question, rather than an easy answer.
I think one of the fun things too is one of the challenges I see a lot of older clients face is when they sell an asset, what do they do with the money? They're retired, they want a lower risk tolerance. At least with the vendor take back side, depending on interest rates, you get a certain return from the debt from the borrower. So it's going to be interesting. For the few brokers that I know that are in here that are quite prominent, I have a lot of respect for you guys. So thanks for joining. There's only a few that I send invites to. But we know that there's issues with the federal rules of OSFI, that they don't like vendor takebacks. So it's going to be very interesting to see how solution, and then it'll hit problems, and then people will find solutions, and it kind of swings the pendulum back and forth. But interestingly enough, that vendor takeback strategy will likely only apply at the personal level. You earlier alluded to the solution of splitting ownership amongst multiple parties, say in a family, also only applies to the personal level. I think it's further nails in the coffin in a sense for corporate ownership. For some, it'll be inevitable. It just doesn't make sense to pull the funds out to buy personally. Now, will these changes, I assume, would also impact it someone who sets up a bare trust if you own it personally but hold it in trust for a corporation?
Not necessarily. Well, if you're holding it for a corporation, you have to remember a bare trust doesn't incur any of the actual income. The income is being realized at the level of the beneficial owner. And so if that beneficial owner was an individual, well, then all of these rules would apply, per the individual basis. If it was a property that you had registered under your own personal name, but there was a bare trust and it was, legally being held and the beneficiary was the corporation, well, then the corporate rules are going to apply and you're going to be dealing with that taxation at the corporate level, right from $1. And
Now,
so in theory, that person might have an easier chance to unwind, because they, in BC, we have to face property transfer tax. I mean, in Alberta, that's not quite as much of an issue. But if you had a bare trust and you might want to unwind the process and no longer consider the property to be owned corporately and to just transfer it back into your name and recognize everything going forward under your personal name, well, then that's going to be a little bit easier. You don't have the property transfer tax issues. But again, you can start to see all of the different layers that start to come into play with these things, going into that same layered thing. The reason why, I mean, I had 5 returns this year alone. Of the 500 returns that I prepared personally for personal tax returns, 5 of them would have been exposed to this tax. And all 5 of them were 85 to 95-year-old individuals who passed away, and they still had significant assets under their personal name.
would you
And so
describe
again,
these 5 as the ultra rich?
no, not a single one of them probably made more than 6 figures in their life, or were right around that mark. And what the reality is, why did they still have those assets in their hands? Well, there's a lot of psychological reasons, right? Comfort of not making sure that you've earned those assets over the course of your 60, 70 years of earning. You don't want to, run out of money. So you don't want to transfer them out of your hands. Or there's the interaction of you realize the gain and the care facility that you are staying at bases your yearly cost on your income. And so if you realize a huge gain, then now your care facility is going to charge you more. Or if you realize the gain, you're going to, have your OAS taken away. It's going to be fully clawed back. And so the reality is, like, without doing the analysis, people will sometimes get paralyzed, and it's easier, or they don't want to see the tax. They don't want to have to write the check to CRA. and they'll just let it get to the point where they pass away and the estate will deal with the tax. And so again, that's the difference between, the psychology versus the reason of the numbers, and, the proactive versus reactive situations in life.
No, absolutely. It's sorry everyone, I'm trying to answer. We're just getting bombarded with questions. I'm trying to answer some in text, so we're not here till 9 p.m. But so it sounds like there will be a few minor solutions to try to navigate or minimize this. But at the end of the day, it sounds like it's mostly reactive, and maybe someone can take a 10% increase in total taxation down to 2 or 3, but there's no silver bullet here, is there?
Oh yeah, there will not be a silver bullet to this. You will not be able to, realize some sort of invisible thing that shrinks your capital gain. That's kind of hope and dreams, and that's not really the reality.
Now, is this also impacts business owners as we discussed? Is there anything that you've kind of identified they may be able to do to try to minimize that?
Yeah, I think like I said, there's going to be a less emphasis at keeping the earnings at the corporate level. So that means that's going to be often very, very large shifts in strategy to push those assets down to the personal level, whether that's higher wages, in order to max out RRSPs or TFSAs, at even larger numbers. All of a sudden, things like individual pension plans start to kick in, IPPs, as again, another way to accumulate assets within a shelter. And then you're going to see, like we noted before, whole life held at the corporate level, is going to also have some additional appeal as well. And so you're probably going to see a bit of blending. I mean, within my own life, I will probably still keep at some amount of assets, that will incur capital gains at the corporate level, but I will probably shift and not keep as many, right? I'll start to emphasize a little bit more at the personal accumulation level rather than, keeping a really, really minimized personal income. It's going to require a complete change in strategy. So again, this isn't going to be a single year solution to this. This is going to be something that changes the way that I navigate, and many businesses navigate for the next 20 or 30 years, or whatever your working career is, as well as your wind down. So, it does have a very significant impact, and you do need to form a plan on how you're going to address the change.
Now, I want to add one thing to everybody. So roughly half of well, 40% of the room roughly is employee, 40% is incorporated, and then the remainder is sole proprietor. For what it's worth, these changes, while an absolute pain in the ass and put my blood pressure up, because as an incorporated individual who has no pension and is going to work for way too long, this takes a direct hit into my retirement savings. And it's a regular guy. Like, I'm not a millionaire. So it's frustrating. But I think there is a silver lining from this change, and that is we're all riled up about this stuff. We're pissed off. Now, while this specific tax, there's maybe not a huge thing we can do, at least generally speaking, especially for us incorporated individuals. There are a lot of little things that already existed that we can do. I think I have the book somewhere around here. Let me find it. Aha. Chris knows where this is going. But as an example, the Smith maneuver. Just one example, which many of you have probably heard of. There are ways that you can create, by optimizing cash flow, tax deductions that you wouldn't otherwise have, which, as an example, if you can convert the mortgage on your home from being non-tax deductible to being tax deductible, and then invest it in, let's say, S&P 500 index shares, where most of the profit is a capital gain, therefore it is realized when you sell, you're creating deductions every year while you're in your earning years. You're pulling more money out of your corporations because these deductions allow you to pull more out while paying the same taxes, because maybe you have an extra $20,000 of tax deductions you created from the tax deductible interest, and you're pushing the capital gains. Maybe you obviously realize them under 250,000 a year in the future date when you're retired, and you're not earning anymore. Hopefully it'll lower marginal tax rate. So I do think the silver lining is that this is going to get people more aware of this stuff. And while we can't change these direct rules for incorporated individuals, as an example, there's a hell of a lot we can do to optimize our personal situations, our estate planning, And that's one of the things that I really hope to give back to you guys is Chris and I spend a lot of time, well, more before tax season, but I want to say thanks, by the way, Chris, for coming out when you're doing 15-hour days and you've agreed to do this before the end of the taxes. But we are going to try to create more stuff to educate everybody and to really show where you can optimize things, because there's a lot of room for improvement. And I see it whether it's realtors, financial professionals, even bloody lawyers, um, even accountants. The number of financial controllers and people I've seen that have a CPA designation, and then you see their whole financial affairs, and it's like, what are you doing? I thought this was your expertise. So there is good news, and that is that probably 99.9% of Canadians leave a lot on the table where there could be increased efficiency from a taxation perspective. So, Chris, is there anything like how severe do you think these changes are? Do you think this is going to change how people should invest?
No, I think as you noted, that with some strategy changes, a lot of the impact will be mitigated. Obviously, there's going to be circumstances that that they're not. It's going to be unavoidable, and it's going to be a significant hit, right? I've got a client who's held a property for 30 plus years, and it's looking like $4 million capital gain, or from $4 million gain. Right? The question is, can he get this deal done before June 24th or afterwards? Because that's a $700,000 difference in income inclusion. And it's those sorts of situations where, there is going to be very minimal, ways of mitigating that. But for the vast, vast majority of people and situations, there's going to be ways to plan around this and to restructure things so that you don't have the same impacts.
I appreciate you sharing. I've always, for what it's worth, everyone, Chris is the accountant that I use personally, and he doesn't pay me referral fees. I don't even know if you've ever sent me a client, but he's one of the best I've ever come across. And I specialize in the real estate investing and tax strategy space as a broker. So I deal with a lot of this stuff, and I've worked with a lot of accountants. And I still, Chris, I'm going to share a personal story about you. But last summer, I called Chris, and he answered because he's an idiot and he's on vacation, and he answers. And he says he's in, where were you? I think you're Karamias, Penticton, somewhere around there.
Oh, well, yeah.
I say, you're on vacation while you're talking to me. Like, let me guess, you're reading a tax book. And all of a sudden, I hear a lady in the background just start laughing hysterically. This is his wife. I caught him red-handed. He had a tax book in his hand. So I'm a believer that if you're going to pick professionals, there's a few things you want to consider. One is their career, the longevity of their career, along with your longevity of your need for them. There's nothing better than working with an accountant who's going to retire 2 years after they set up your plan. And then the other thing is someone who's kind of passionate and quirky about this stuff. And that's what I love about Chris, is that the moment these changes were announced, even though he's super busy working long hours, he started digging into this, and he agreed to do this. And he's not getting paid for this. I'm not getting paid for this. So I just want to say thanks for showing up, Chris. Do you want to trigger the last poll just so we can get an understanding of, we're going to do some follow-up. We have all your emails. I'm a marketing guy. We're going to follow up with you based on kind of what you're interested in. So these polls, you can answer multiple if you like. This is just to understand what you care about. So when we send the changes, how they'll impact you, I want to try to hit the mark. So thanks for sharing. It does mean a lot, and it makes it a little easier. Chris, do you have time to try to bang through the 30 unanswered questions that we have?
We can give it a shot. I mean, within the context of, obviously, that we don't know everybody's individual situation and we don't know the actual laws.
So I'm just going to start, we'll speed round these, because at the end of the day, it's all going to come back to talk to a professional. But if a property is owned by a corp, rather than selling the property, the corp sells its shares, would that work around triggering the capital gains consequently with this new change?
No, because I mean, the sale of the shares in reality may be a larger capital gain. For instance, if you had purchased your shares for $100 and the company, or sorry, the property within the company you purchased for 500,000, well, your adjusted cost base on those shares is $100. So let's say it has $1 million value at that moment. If you sell the shares of the company, well, then now you have $1 million gain to deal with, rather than a $500,000 gain if you were actually selling the assets within the company itself. As we noted before, The qualified small business rules don't apply to companies that are holding passive income, and they're very strict in their application. So you wouldn't be able to apply your lifetime gains exemption against that, for instance, $1 million gain. So again, you'd have to do the math, but generally speaking, the cost base on your shares is very, very low. And so you'd have an increased gain in reality by doing it that way.
So someone heard that rental property is considered a depreciable asset, and the net of the buy sell should be included in the final rental income, not the gain loss. How much of that's true? That question doesn't fully compute for me, but maybe you've got more experience to.
Yeah, I mean, there's a lot of different people do their research in the US or they follow videos and that sort of stuff, but depreciation is going against the active rental income, and it has to get added back at the year of the sale according to Canadian rules. But that income addition of the depreciation coming back comes in under the rental schedule and under the active sort of, not the active, but under that line item, whereas it doesn't affect the capital gain at all. Capital gain is purely calculated separately, and that's based on the adjusted cost base of the property and the selling price.
That was my first misconception, was that depreciating properties was going to drastically increase the capital gain and cause this 250K limit to trigger sooner, but Chris set me straight. If you move into your rental, let's say you sell your primary residence, how long until that investment property is considered your primary residence? Are there any ways to avoid these capital gains?
No, CRA has been doing this a long time. There's what are called change of use rules. And so when you change the nature of the use of a property, it is considered to be sold. So whether that is changing it from being your primary residence to being a rental property, that is generally considered a sale. In the same way, if you move into the property and it was formerly a rental, well, then you would have to consider it sold, pay all of the old gains that had accumulated up to that point, and then only the growth from the time that you were living in it to the future sale would be tax-free. But they make you settle your accounts on that old growth. So you're not going to get around this by moving into old properties that have gains built into them.
Now, someone's asking about selling something over a few years, i.e. you pay me, let's say, a third of the sale price each year. I suspect that for a business that may work, because there maybe is a justification while the business is being sold gradually, is maybe you work your way out. But what do you think, Chris? Gar?
Well, I mean, first, I mean, that's what a vendor take back is, right? That's a payment, that's a sale where you're getting paid over multiple years. So, I mean, that kind of answers that. But you have to remember, anytime you stretch out a transaction, there's going to be risks tied to it. Whether you're in a weird situation where you don't own the company, or you still have a residual ownership of this, and the owners take the company in a different way that you don't want to see it. There's going to be downsides to any strategy that you try to do, and a longer that a sale is dragged out, especially for legal purposes, it can get hairy pretty quickly.
And the one thing that I speak to the real estate investing community here, there's something called GAR, which is essentially doing things strictly for taxation benefits, and it basically means the CRA hits you with a stick. Just because we can do it with creative financing or structuring a contract, please work with a good CPA, because there are rules specifically to, you think you've outwitted the system. If you do something strictly for the purpose of outwitting the system, they hit you with a stick and they may bankrupt you over it. So someone asked a question about if you're buying a lot of real estate, is it much harder it is much harder to finance large numbers of units? And yes, absolutely, you are correct. If you are a large scale real estate investor, the only strategies that really work for consistently financing properties at a large scale are commercial and small business financing, which case, generally speaking, they have to be corporately held. So sadly, this is just going to be an inevitable reality for some people, especially if you're an incorporated realtor, let's say, like the one answering the question. You're going to have a ton of money stacked up in your PREC, your real estate corp. You're going to move it probably to a holding company. You can't take all that profit personally, or you're going to screw yourself. So last thing you want to do is cut off your hand to try to save a finger, right, everyone? So please talk to professionals. Um, I guess essentially, will this change the exit strategies of investors that have already built up portfolios? I imagine yes. What do you think, Chris?
Potentially. I mean, the reality is that there's only so many ways that a person can exit. And so, people are going to have, and the historical aspects of a company come into play. And so, again, every situation is going to matter. I don't think it's going to be as easy as saying, that everybody will wind down differently. It's just everybody will have to evaluate how they're winding down.
I certainly think we'll see for personal ownership a large benefit to exiting your portfolio over a period of time rather than doing it at once or waiting till you die. And I think sadly, the waiting till you die one is going to catch a lot of people. I work with a lot of real estate investors. The most common thing I see is that people buy real estate for two reasons: for passive income and for their kids' legacy. Well, passive income is pretty straightforward. What they forget about is that when they pass, the CRA basically says you owe a lot of tax, your estate does. So what do your kids do? They take your 5 million or 10 million, whatever it is in real estate. Well, they have to come up with $3 or $4 million in tax. They sell the bloody portfolio, and then they get that $1 million check you didn't want them to have, and the whole business you built is gone. So please plan for this stuff.
Well, and some of it, what's the serenity prayer? Allow me to control the things that I can control, and the whatever about the things you can't control. And so again, we started the conversation about getting down to what your actual goals are, because maybe you get a little bit of a whole life policy at the personal level, and you only fund it enough so that it eventually has the cash in it to pay your tax bill. Right? You're not necessarily going to get away from the tax bill, but if you have awareness, you can plan around it. So if you have some source of liquidity, well, then now, you didn't have to come up with every dollar of it. There was growth within a policy that came up with paying part of the tax bill. And so again, there are strategies or things that you can put into place to deal with the long-term effects if you're not able to avoid them completely.
No, absolutely. It's going to be a doozy, but I think being proactive is going to make a huge difference. Now, someone asked, oh, sorry, I want to add something real quick. We are recording this. I know we're hitting an hour, so especially for you guys in the East Coast, these questions will all be recorded and posted with the answers. So if you do have to run, please don't feel guilty. You will get the answers. Selfless plug, I am going to be putting it on my YouTube. So if you want the notification when it goes up, because I do have to process all this, just subscribe. So if someone's selling under a nonprofit and incurring a profit, maybe that's way beyond me.
Yeah, I don't deal with nonprofits, so I'm not sure. And again, how those rules, it will depend on how the actual laws get written.
Someone's asking if the gain is over 250K, the first 250K is at 50% rate, remainder is at 66%, or is it 66% on everything? It's the first scenario if you own personally. In the case it's corporate, you pay 66 on everything. So it just depends on how you're structured. Someone's asking if it's not ratified yet, how can the June 25th date start the process if it's not been brought into law? It's the government. They're going to do what they're going to do. We don't know yet. Is there any chance the ruling will not get passed? Is there anything we can do to help not get this passed? Write your MLA? I don't know. It's
I mean, the doctors are quite opposed to this, and I mean the medical association has put together a strongly worded letter, and so I imagine that other organizations and other people are putting together letters, and hopefully, maybe a change can be made, but it's a matter of pressure. The reality, and here's the sad thing is, if you go and browse social media about this tax change, you will see a lot of eat the rich comments, I mean, I wish I was so fortunate to have, you know, a $250,000 gain. I can't buy my first place, and here's somebody whining about, you know, the sale on their second place, and you aren't the property owners, especially you know, secondary properties. That's only 10% of the population in Canada, and business owners again are another small percentage of the population. So, you know, from a government level, there's a whole lot of people who are quite angry on the other side of things with the cost of living, you know, crisis that many people are going through. And, you know, there's not necessarily going to be sympathies. I think I think the government is actually facing more pushback than they realized, because consistently polls have said that Canadians don't oppose making rich people pay more tax. But I don't think that they realized all of the people who are going to be affected, and that it's broader than just the 0.13, and or that you know, statement isn't holding water when looked at closely.
They only spent 50 million on the study, and they should have spent 100 million to figure it out. Um, Someone's asking about what about the litigation side of purchasing properties in a corp? So neither of us is a lawyer, but I do work with a lot of real estate lawyers, and an individual I asked this question to, not on this tax, but for corporate ownership. In 40 years of his career, he said he's seen 3 situations where a corporate structure served its purpose from a liability level for just regular residential real estate investors. My best answer is don't set up a very expensive corporate structure for liability when you could get an inexpensive insurance policy to cover against the liability. We're not in the US. A lot of the real estate investing community is influenced by bigger pockets and other US bodies. There's a different set of rules here, and liability is very important, but there are usually relatively cheap ways to cover that liability with an insurance policy rather than a full-blown corporate structure where if that does happen and all your assets are in those corporate holdings, you're going to lose all your assets anyways. So I think it's a overstated concern, and my advice is talk to the professionals, insurance people, and lawyers about the alternatives. I think we've got a semi-political one here, but why isn't this discrimination? I don't know. It's taxation. It's always discrimination. The people who earn more or work harder,
Well,
smarter, pay more. It's just
it will always affect one group more than other groups. Any tax law.
So someone said that I missed a retroactive date. Basically, if this is ratified and you realize capital gains, these new rules apply regardless of when the property increased in value. So there is the retroactive date, I guess, as always. It's based on the potential gains you have available. Someone said
it doesn't matter if you bought the property in 1950 or you bought it tomorrow. If there's a huge gain and it gets created after this trigger date, it will be affected. So you may have had one set of tax assumptions going into things, but once that date goes past, you'll be under the new rules.
Now, someone asked about the primary residence capital gains exemptions on acreages. Do you have like a 25-second definition on that?
Yes and no. It's very, very complicated. You know, a gains exemption according to the letter of the law is restricted to a half acre, which is 1.24 acres, and the building. So generally, if a property is more than 1.24 acres, you have to be able to opt in to having more of the land included. And there's a lot of different rules as to whether you get to opt in to that or not, or whether there's segments of the property that get to opt in. Obviously, CRA is going to take you know, you have a 10-acre property, CRA is going to take the side that 8.76 acres is going to be of excess land is going to be taxable. And you're going to take the position that, no, I couldn't do anything with that and I had to sell it and everything is exempt. And the question is what your set of case facts are and how everything occurs. And that's from zoning. That's you know, a lot of different factors that come into play as to whether there's inclusions or not. But the law is 1.24 acres. So anything extra than that is because you have you know, you have an opt-in or a rule set that allows you in.
Someone asked if they can add non-Canadian owners to properties. Maybe, but you better really look up the taxation rules for foreign ownership of real estate, because you might take your whole arm off trying to save a finger there. So talk to
Yeah,
professionals.
you don't even get you're not even legally allowed to get paid 100% of the proceeds. There has to be holdbacks at the lawyer level when there's a foreign owner involved. So until there's a clearance to actually release the funds. So there's a whole lot of rules that would come into play there.
Someone said they've got shares in a company that is set up as a bare land trust that owns properties that have been held for a long time. Would it be calculated differently or pretty much the same?
Pretty much the same. I mean, again, it doesn't matter the historical length. It's a matter of either this trigger date or not the trigger date, and whether it's corporate or personal.
Someone's asking about owning real estate assets in a corporation where you keep refinancing out the equity, the principal paid out, or the principal pay down, the appreciation, and use it to fund things like our whole life. Yeah,
The amount of debt tied to a property has no effect on its cost base. You could have, if you purchase a property for $10 and it was worth $1 million and you took a full $1 million of debt against it, you would still have a huge embedded gain when you eventually sold and a big amount of tax. But the reality is you might not have the liquidity to pay the tax and the debt back on that sale, and so you'd have to be worried about those things. But the amount of debt doesn't affect cost base.
Someone's asking where there's multiple, so maybe one person on title, but multiple beneficial interests, say one person personal, one corporately. Is it correct that the taxation is realized at the level of the ownership?
That's right. Yep.
Sorry, everyone, if I cut out, by the way, my internet service provider decided to do maintenance today of all days. So, Chris, do you recommend people no longer purchase properties in their corporation?
I think everybody needs to create a plan and have a chat. I don't think that there's going to be easy rules.
Someone's asking if they're going to rescind these changes. I don't think so. I think the government needs money desperately, and they're borrowing and spending more. And regardless of the party that gets elected next, the country needs money, and they have to bring it from somewhere. And it's certainly not going to be the poorest 80% of Canadians. So
I potentially think the reason why there's the June 24th date is because they're trying to panic people into selling so that they have extra amounts collected going into the election, and they could say our deficit was a little bit lower than what it actually was, from a pure optics perspective.
someone's saying leverage assets instead of selling. Yeah, that avoids the taxation, but it pushes it further and further. And sooner or later, your kids are going to inherit it when you die. So you got to plan.
Yeah, in Canada, there's no way out of, there's no step-up basis on death. You have a deemed disposition, so the tax bill will hit whether you've leveraged it all the way or not. It's either on sale or on passing. But it's going to get triggered.
Someone's asking if we can confirm whether the closing date on or before June 24th matters.
I'd have to look more into it. I think the rule is June 20. Yeah, you'd have to look at the law.
It's an imaginary date till it's not. So
yeah,
scary thing. Someone's asking if it makes sense to do the Smith maneuver on a rental property, now personal or corp. I can answer this one. No, the debt typically on a rental property is already tax deductible. Smith maneuver is a conversion strategy. Paying down tax deductible debt to reborrow in a tax deductible way to invest does not make sense, but you can use the same product to access the principal you pay down and get more money out working for you. So it depends on how you understand the question you're asking. The conversion, no. The use of leverage, sure, but be careful with your leverage. Just going through. There's a few people asking Chris about can they get your information? What types of clients do you take on? I'm going to prune the questions if you want to give everyone a spiel about who you are, what you do, and what kind of clients you're looking for.
Sure. I mean, at this point, after the shell shock of the busiest tax season I have gone through, I will be not taking that many, if any, personal tax clients. My focus generally of my firm is owner managed corporate business. That's where the bulk of our business is, and that's where our ability to grow and take on clients will be. I don't, and I certainly can help with some consulting components. I don't have a problem with consulting people if they are, just personal only. But there is just a huge bottleneck when it comes to getting all of the work done at a fixed timeline for personal taxes. And generally speaking, we try to have a holistic view. And when we take on a corporate client, we like to deal with their personal business as well, so that we can have everything integrated, which means that as our corporate business grows, we have a natural growth in personal tax clients.
Someone's saying, would owning real estate under a cash value whole life insurance escape this? You can't own real estate under a par whole life policy. But you can use a par whole life policy to build assets to deal with the taxation of the real estate.
It can be a funding mechanism, but it's not an ownership mechanism.
Got all the books on it right here. I don't sell it. Chris doesn't sell par whole life either, but it is something that we're both interested in because it allows us to plan to have reasonable retirements while still building up ways to mitigate the taxation of, hopefully we get to keep enough of our earnings to leave to our kids one day. So just beware that, at least in my humble opinion, par whole life is sold by people to the wrong people quite often. It's a too much money problem, at least in my opinion. And if you have the problem of you have too much money, yes, par whole life can be useful. But if you have the problem of you need to build a retirement, it may not be the right solution. So I don't know if you have anything to add on that, Chris, but
yeah, I have the similar. I think it's most impactful at a corporate level when it's funded at from other corporate earnings. I think that it is a powerful strategy, but it's not a broadly that it applies to everyone. I think there are other strategies that take precedence. For instance, TFSAs, and that's my main thing. I think every person should be aiming to get their TFSA maxed out, because even if you were to take a heavy proactive RSP strategy going forward, you are again dependent on what the tax rates are in the future. We don't know what the realized rates when you actually go to take the money out of your RSP are. Whereas the TFSA, you fund it now with today's tax rates and you don't worry about it going forward.
Murphy's Law, my internet died the last 8 minutes of the webinar. So here I am the next day, just quickly filming kind of the end to it all. So the changes overall are going to have, a reasonable impact, but we can stay ahead of them with just a little bit of planning. If you have any questions, need any help, or you're not sure about anything, please reach out to me, leave a comment, whether it's myself or I'll get Chris, we'll get you the proper answers. And if there's anything we can do to help, just reach out. If you don't mind doing me a favor, please subscribe, because we're going to do more stuff on this. And Chris and I are going to be working together to create some higher level courses on planning, tax mitigation, how we tie a real estate portfolio into the tax planning, how we make it so that if you leave something for your kids, they get more of it, how to avoid being forced to sell it. Well, how to avoid having your kids being forced to sell your portfolio at the estate level. So we're going to be doing a bunch of interesting things. So I hope you guys enjoy it. Please give us feedback on what you want to see, what you want to learn. Thanks again for coming out. See you soon.